Hello viewers, in this video we will be going over leverage ETF for market indexes and more importantly look in time decay of these ETFs. A traditional ETF typically tracks underlying index on a one-to-one basis. Leverage ETF amplify the return of an underlying index. Typically leverage ETF aims to move twice or thrice a traditional ETF. Let's look at the leverage ETFs for Nasdaq, S&P, and Dow Jones. In this chart, QQQ represents ETF that closely tracks Nasdaq, SPY closely tracks S&P, DIA closely tracks Dow Jones Index. Here are some leveraged ETFs. QLD amplifies the movement of Nasdaq by 2 times. In other words, if Nasdaq or QQQ moves by 1%, QLD moves by 2%. For S&P, the 2 times leverage ETF is SPUU, and for Dow Jones it is DDM. Similarly, TQQQ amplifies the movement of Nasdaq by 3 times. If Nasdaq moves by 1%, TQQQ moves by 3%. The 3 times leverage ETF for S&P and Dow Jones are SPXL and UDOW. There are also inverse leverage ETFs. An inverse leverage ETF amplify the returns of an underlying index in opposite direction. This chart shows inverse leverage ETF for different indexes. So for example, if the market goes up by 1%, the 2x inverse leverage ETFs move down by 2% or minus 2%. Similarly, 3x inverse leverage ETFs would move by minus 3%. Now consider, if the market goes down by 1%, these ETFs will go up by 2% for 2x ETF and 3% for 3x ETF. Let us look into the time decay that is involved in leverage ETFs. This is a simple fascinating algorithm shows how a trader can lose money in these leveraged ETFs, even when the market remains flat. Consider all the traditional and leveraged ETFs are trading at $100. Let's go over some hypothetical movements. On day 1, the market falls down by 10%. The 1x would be $90, 2x would move down by 20% to $80 and 3x would move by 30% to $70. On day 2, the market falls down by 10%. The 1x would be $81, 2x would move down by 20% to $64 and 3x would move by 30% to $49. On day 3, the market again falls down by 10%. The 1x would be $72.90, 2x would move down by 20% to $51.20 and 3x would move by 30% to $34.30. Now consider, the market changes course and starts going up. On day 4, the market goes up by 10%. The 1x would be $80.19, 2x would move up by 20% to $61.44 and 3x would move up by 30% to $44.59. On day 5, the market goes up by 10%. The 1x would be $88.20, 2x would move up by 20% to $73.72 and 3x would move by 30% to $57.96. On day 6, the market goes up again by 10%. The 1x would be $97.02, 2x would move up by 20% to $88.46 and 3x would move by 30% to $75.34. Finally, on day 7, the market goes up by 3.08%. The 1x would be $100, 2x would move up by 6.16% to $93.91 and 3x would move by 9.24% to $82.30. The traditional ETF started from $100 and returned to $100. Whereas, for the same movement the 2x ETF is still down by more than 6% at $93.92. The 3x ETF is down by more than 17% at $82.32. This is a simple time decay algorithm in financial engineering. The longer market remains flat, the more its decay in dollar value. Many traders do not realize this time decay. The time decay is also mentioned in prospectus of leverage ETF. Here is an excerpt from the prospectus of TQQQ. It says, TQQQ seeks daily investment results that correspond to 3 times the return of the Nasdaq 100 index for a single day, not for any other period. This loosely translates to, you can lose money if you hold for long term even if the market remains flat or go up. Leverage ETF is good for day trade and not for long term. We hope you enjoyed the content of this video. Please hit the like button if you did so. And finally, thank you for watching.